What's going on, everybody? Welcome to our Q&A live session for March. Appreciate you guys being here. We've got Al. What's going on? Good to see your face. Ray, Evelina, Julia, welcome. Thanks for being here, guys. Really appreciate it. Um, we do these Q&A sessions on a monthly basis, and we love doing them because we want to make sure that people have kind of touch points with a CPA. We want to make sure that people have the ability to come into the group chat here, post their questions, and make sure that they're getting answers to the things that they're wondering about. And so, usually around the middle of the month, I will put together this webinar and just essentially give you guys some office time with me. And it seems like we sometimes we have good numbers, sometimes we don't, but that's what it's here for, is to make sure that everybody's just getting answers. If you have any questions, feel free to pop those questions into the chat. Um, I should be able to get to all the questions unless you guys have tons of them. But yeah, jump into the chat. Just feel free to drop them in there. And then I will kind of be getting into them as I kind of run through each one. So, Brandon, welcome in, man. Appreciate you being here. All right, the first question I got was centered around inherited IRAs. So, what an inherited IRA is, it's when somebody has a traditional IRA and the you pass away, and that IRA has a beneficiary that's maybe a kid or a family member. There are rules in place that say that the inherited IRA has to end up taking RMDs, but also that within a 10-year period, those that account basically needs to be drawn out. And so the question was centered around what happens if that inherited IRA is invested in things that are longer than 10 years, like maybe like a note or something like that. And so I kind of did a little digging on that and just found out that when it comes to the inherited IRA, no matter what is in that account, it's got to be drawn out within a 10-year period. So not a lot of flexibility there when it comes to the IRA stuff, but definitely wanted to just kind of jump into that one. That was a good question. Another question I have is, do I need a 1095B if I'm on Medicare? No, you will not be issued a 1095B if you're on Medicare. If you're in California, you're able to check the box that says that you have insurance coverage so that you won't be penalized there. So, yeah, Medicare does not issue those. Another question I got was, can I make charitable contributions from my business, an LLC or a C Corp income, and take it as a business deduction? Due to the high standard deduction, I can take advantage of my charitable contributions on my personal return. All right, so when you make charitable contributions through your business, it is a separately stated item on your K1. So, like if you made $100,000 revenue and then you had operating expenses of 50,000, net income would be 50,000. If you ended up doing like a separate $10,000 in charitable donations, you would still have net income of $50,000 in the ordinary box, but then in the charitable deduction box, you would have a separately stated $10,000 deduction. And what happens when we go and prepare those personal returns is we kind of put each of those separately stated items in the right spot on the tax return. So paying your charitable deductions through your business or personally really have the same impact. What I tend to tell people to do is just pay them personally. But it has the same impact. And, there's not like a deduction from ordinary income for a charity. Now, that's with your partnerships, S corps, disregarded LLCs. C corp charitable deductions are a little bit different. C Corp charitable deductions are a deduction against your taxable income at the corporate level, but there's a limitation that you're only allowed to donate and deduct up to 10% of whatever your income is. So if you made $100,000, you would only be allowed to have a $10,000 charitable deduction. Anything that's over and above $10,000 would just carry forward in the future. So LLCs and C corps are a little bit different that way. All right. If buying real estate, if my older parents together, they will hold the loan, but all of us will be on the title. At some point, the mortgage will be paid off, but they don't want to pay any gains taxes. They want to start transferring funds to their kids now while alive, then a full inheritance once they pass. How do we do it so they don't pay capital gains tax? All right. So, what we end up doing on something like that is if they're on the loan and the title, they do have ownership to that thing. But, like, let's say, for example, when the mortgage is paid off, they can deed their portion of that over to you. So, and like remove themselves from the title. So, that's kind of like to make sure they won't pay any capital gains tax. That's kind of the way to go about that. Now, if there's a sale of the property, I mean, that gets a little sticky because they're on the title, they're on the loan. Okay. So, I mean, like, if you sell the property, it's one of those things where maybe you could report it that you would take all the gains, but like if they have like a quote unquote an ownership in it, then technically they should be reporting their share of it. If it was a hold situation and it was just going to be a hold situation until they die, that's actually a good thing because when the parents pass away, whoever inherits the property actually would get a stepped up basis over what you paid for the property based on the fair market value of the time of their passing. So there's a way to do it. Okay, there's a way to do it. They could kind of start transferring some funds while they're alive. um, if they ever give more than 17,000 to a specific kid, it's actually 34,000 if both parents are alive. They would have to file gift tax returns, so just look out for that. There wouldn't be any tax due, but it would be something that you would have to still file with the IRS. But overall, there's definitely a way to not pay capital gains tax. It usually will include deeding the property over to the kid that is supposed to have it, or passing away and giving the kid a stepped up basis. If I ever answer a question and you have follow up, feel free to just drop that in the chat. If I didn't like kind of make sense, you want some clarification, feel free to drop that in the chat. Got a couple other people joining us. Good. Mike, welcome. All right, you'll define my tax return costs to you last year among my disregarded LLCs as necessary. All right. So what Al's saying there is a little trick of the trade that I think is worth mentioning. Um, Tax prep fees for personal taxes are not deductible. And so, one of the kind of tricks that we've kind of come up with is dividing up tax prep fees between what really is allocated to personal and what is allocated to business. Wow. And so, hold on one second. Hey, Johnny, will you give me some water? All right. So, sorry, I got a little bug in my throat. So, what we do, like, let's say somebody, just for round purposes, has three rental properties and then they have kind of your normal personal stuff. What we would end up doing on that is saying, okay, if the tax prep fee is $1,000, then what I would kind of do is say, okay, I want to reasonably kind of break that up. Maybe just like if I didn't have any rental properties, then my tax prep fee would be, a couple $100 probably. It'd be really easy. Maybe you'd even prepare it on TurboTax. But if I have three rental properties, and that's like kind of what's driving my tax prep fee up, because now, the accountant's going to charge me more because they have to deal with these rental properties. Then we're in this spot where I say, okay, you know what? Maybe what I'm going to do is I'm going to take 250 and I'm going to apply that 250 to each of those properties and put them on the schedule E's. And so there's kind of like a reasonable breakdown that we would do. It's a little trick of the trade, just trying to allocate those personal tax prep fees so that some of it is deductible. And I think that's totally legit to be able to do. I've never seen any challenge to that type of thing, as long as you have like a reasonable allocation for how you're doing that. We usually take whatever we can and allocate towards the business and kind of do that in a fair way. The same could be said that if you had like an S corp and a personal return. If you reached out to me and said, "Hey Ronnie, how much would it cost to prepare the taxes?" If I said, I mean, normally I would charge $1,000 for your S corp and $1,000 for your personal return. Maybe what I would do is say, why don't I just charge you $1,600 for your S corp, $400 for your personal? Now the 1,600 is deductible on your business return. The 400 is non-deductible, but we still made it reasonable. Still kind of squeezed out a little bit of expense there. So the tax prep fees, even though they're generally non-deductible on the personal side, is something that we would definitely look at. Let's see here. I am the owner of an employee of a C corporation. For the Augusta rule, what kind of documentation is required beyond meeting uh, and to just write myself a check? What should go on the memo line? Do I need to send an invoice? Let me talk a little bit about the Augusta rule. The Augusta rule is something that maybe you've heard on TikTok in a 30-second video where they say, hey, you know what? You can write your house off for 14 days and take thousands and thousands of dollars worth of deductions. Okay, yes, there is a way to do that. Let me talk to you about the way to do that. What the Augusta rule is people were renting out their houses to people who are at the Masters tournament. And there's a little section in the code that says if you rent your house out for less than 14 days a year, you don't have to claim that rental income. Well, so businesses kind of got smart with this and they said, well, why don't I rent my house to my business to hold meetings instead of going and getting meeting space? Then my business can take a deduction and personally, I don't have to pick up any of the income. It is smart and we do it. But the way that it needs to be done is very, very particular. You have to go about it a certain way. Number one, Number one is you want to make sure that you have the fair market value of what your house would be worth for a rental day locked in. Okay, you could go to Airbnb, you could get some quotes from a local meeting spot, but you want to make sure that you have a basis for the number that you're using. So let's say you're using $500 per meeting. What we're going to end up doing is $500 per meeting. You can have up to 14 meetings. So let's just say for round numbers, you have a monthly meeting at your house. What I want you to do is keep agenda, have minutes, take notes. That way you have a justification of like, yes, we had that meeting. We have meeting minutes. Here's what we discussed. Here's who was there. This is how we were doing trainings. We were talking about our business. Whatever it is you were doing, make sure that you have a basis and a documentation for actually having that meeting. The next thing that I would want you to do is actually write yourself a check from the business for the $500. So you're going to say $500 times, like if you have the meeting, one meeting, write the check. 500 from Ronnie's business to Ronnie. Now there's a paper trail of the money that moved between the business and the individual. All right. And if you kind of do those things, you have your ducks in a row. Um, where people get in trouble is when they skip this kind of stuff. I'll have somebody that comes to me in March and they say, "Oh, hey, here's my books, but oh yeah, just so you know, I had 14 meetings and they were $1,000 each." And then I'm sitting there like they want me to just adjust it into their books and write it off for them. And it's like, no, you know what? Like, you need to kind of like have your ducks in a row on that kind of stuff. That needs to be something that's paid out. I don't want to do that in the end for you when you're just like making up deductions. Like, I don't know if you had those meetings or not or anything like that. So, if you're going to implement the Augusta rule, it's a really good idea, but I would want you to do it the right way. All right, let's see. What else do we have? If you were going to put a memo on the check, you can just put like meeting space rental. All right, and something like that would be totally fine. All right, let's see. What are the various methods used to compute an office expense of your personal residence? All right, so like you could see, I work in a home office here. Okay. Um, I record my videos here. I do my tax work here. I meet with clients here sometimes. Like I have a dedicated home office space that this is all we use it for. All right. In my case, it's like a 12 by 12 room. Okay. So I have 144 square feet. And let's just say I have 2,800 square feet in my house. Okay. So for me, I have like 5% of my house is going to be home office deduction, home office portion. All right. So what I could do is I could take 5% of my mortgage interest, my property taxes, my utilities. If I bought furniture for my office, I can deduct that. But really, it's like 5% of that kind of stuff is what I can get. If I do that, I can reimburse myself from my business for that. So write a check from the business to the personal to reimburse for that sort of stuff. Um, as far as another method, that's like the calculated out method. There's a simplified method too. The simplified method says take your square footage of your office times $5 a square foot and take a simplified method deduction. So there's that option too. So that's a couple ways that you can kind of write off a home office. A lot of people say the home office is a red flag with the IRS. I tend to agree with that kind of stuff. Um, I tend to agree. Um, but it doesn't mean that I wouldn't take it. A lot of people will say red flag. Should I not take that deduction? I don't do that unless like you don't really have a home office. Like I don't want you to make it up. That's a red flag. But if you do have one, then let's take it. Um, Couple clarification points. Okay, 2024, the annual gift exclusion jumped up from 17 to 18,000. So I said 34,000. That should be 36,000. Thanks, Ray. Um, Home office deduction. Can I include landscape and maintenance? Uh, you probably could. A little bit of a stretch, but you probably could. If you have a cleaner that comes to your house, I would say include that as part of it too. I think a couple of things that I told you aren't like all inclusive of what you could, but in theory, it is like the costs that you have to maintain your home. So, yeah, I would probably say that could be fine, especially if you're in a spot where people are coming to your house and are meeting with you in person. All right. Can I deduct both medical insurance premiums and non-reimbursable medical expenses as business expenses? The answer to that is no. Me- uh, like medical qualified medical expenses, like kind of like going to the doctor and that type of stuff, those are deductible medical expenses as an itemized deduction. So your out-of-pocket costs like that are going to go on Schedule A of your personal return. They're not going to be like on your S corp or your partnership. I'll get to a C corp in a minute because it is a little bit different. But for most businesses out there, your out of pocket costs are distributions and then recorded on the personal return. Medical insurance premiums, a little bit different treatment depending on the type of entity that you have. If you're self-employed and you just have a Schedule C, if you have profitability in that, there is a line item where you can put medical health insurance. Okay, so we've got an above the line deduction for health insurance premiums on the personal return. If you're a partnership and the partnership is paying your health insurance, it's actually a guaranteed payment, considered a guaranteed payment to the partner. So it is a deduction, but it's also something that gets picked up as income to you personally. So it kind of washes out. On the S Corp level, if you're a more than 2% shareholder, you've got to include your medical insurance premiums as part of your W 2 compensation. And this is something a ton of people screw up. Medical expenses medical insurance premiums go into box 14 as S Corp shareholder insurance premiums, and then they increase box 1 of your W 2. You have to let your payroll company know that that's what's going on there. When that happens, you can deduct it on the business as wages, and then what happens is on the personal side, then you could put it in as an above the line deduction. So, a couple different things there when it comes to health insurance premiums. Now, in a C Corp's a little bit different. Medical insurance and out of pocket medical costs are considered fringe benefits to shareholders. So, if you're reimbursing yourself for medical, out of pocket medical expenses and you have a C Corp, you can deduct that stuff as a fringe benefit there. So, that's a good question. Let's talk about travel expenses. Travel expenses, somebody asked, hey, if I go to California and I fix up my rental properties, am I able to write that stuff off? How does traveling to other states or travel get deducted? All right, so when you travel, you're going to have either like mileage, you're going to have a flight, you're going to have lodging, you're going to have meals. Um, Maybe there's some other things, but that's the kind of the main stuff that's coming to mind there. When it comes to writing that stuff off, writing off trips, business days are kind of counted based on work days. So if you go and you work 4 hours in a day, then that is considered a work day. So if I leave on a Monday, like I go work in Vegas. So like you guys, some of you probably know, I live in Utah. My office is in Vegas. When I do that, I will maybe leave on a Monday morning, drive to Vegas, leave early. Drive to Vegas, get to Vegas midday, and then I usually work my office. So if I go from Monday to Sunday, let's just use that as an example. If I end up going Monday to Sunday and I work Monday through Friday, 4 hours a day at least, and then on Saturday and Sunday, I'm just like hanging out, relaxing, maybe having a good time, watching the NCAA tournament maybe on Saturday and Sunday and just hanging out. Then I've been gone for 7 days, but only 5 of those 7 days I was actually working. So 5/7 5 out of 7 of my trip would be deductible. You're not able to deduct like hangout days. Now, if I did Monday to Monday, and let's say I worked a half a day on Monday and then traveled home, so total I'm gone 8 days. But if I bookend my trip with work days, then the weekend doesn't count against you. Okay, so I'd be able to write off 100% of that trip. What it all boils down to is how many days was I there? How many days did I work 4 hours a day? And if you're working 4 hours or more in a day, then it counts as a travel day. If you're not working 4 hours in a day, then it counts as a personal day. Travel, yes, that would count as hours towards working. So if I spend 5 hours driving to Vegas, yeah, that counts. Especially because somebody like me, I'm going to be in my car, like most likely talking on the phone, doing appointments like while I'm driving and on the road. So on speakerphone, of course, so nothing unsafe there, but I totally do that. So yes, travel does count. All right, let's see. Um, what are the tax and legal benefits of making an owner loan to my LLC rather than capital contributions? I'll just say my preference. If you have an S corp or a partnership or a disregarded LLC, we're not going to do owner loans. Okay, especially if you're the sole owner of that thing, I'm not going to do owner loans. I'm going to call that a capital contribution every time. It doesn't really actually matter. If you do an owner loan, then you kind of have to like set up a interest rate, make payments, and all that kind of stuff. And it's really just an in and an out. So you'll have interest on one side, interest expense on the other side. It just washes out. Doesn't make a lot of sense for me when you have like a solely owned LLC, a partnership, or an S corp to do owner loans. I know people try to get kind of cute with that sometimes, but I've never really seen the benefit of that. If you have a C corp, you want to do an owner loan though. Owner loans, shareholder loans in a C corp are good to do because C corps are really rigid. If you take money out of your C corp, it's a dividend. So if you put $100,000 in as a shareholder loan to fund your company, your C corp, or something along those lines. If we call it an owner loan, then the first 100,000 that you take out is not going to be considered a dividend to you. It's going to be considered a repayment of the shareholder loan. So that's maybe where you would want to do that. Let's see here. Are any home improvement projects tax deductible? Um, Personal residence stuff, generally going to be no. Now, there is some tax credit type stuff if you're doing like a solar project. Something like that could give you a benefit. But for the most part, general rule is personal home improvements are not going to generate like tax deductions for you. All right, somebody wants me, Ray wants me, and again, if you got any of you other guys that have come in late, Joel, thanks for joining. If any of you guys like have questions, the way to do it is just to pop them into the chat there, and I will get to them. I'm gonna spend a few more minutes here, running through some stuff. So, can you review the real estate professional rules? Do you need to make this election every year? How do we make this election? All right, so people love to be considered a real estate professional because if you're considered a real estate professional, you can write off all your losses against ordinary income. Typically, real estate is a passive activity. And if I have a job where I make 100,000, well, 200,000, let's say, and if I have like a rental that gave me a $10,000 loss, usually this bucket is active, this bucket is passive, and the passive can't offset the active. But if you're a real estate professional, let's say you run a brokerage or you are a real estate agent or you're a flipper and you have this 200K salary, if you have 5 rental properties that have $25,000 worth of losses and you're a real estate pro, Now the 25 can offset the 200. So that's kind of nice. But here's the deal. In order to be a real estate professional, you have to have 750 hours of time spent in real estate work. Okay? You have to have over 50% of all of the work that you do dedicated to real estate. So there's two hoops that you jump through. All right. You also have to materially participate in your rental properties. So you have to have time into managing your rental properties and working through them. Okay. That is how you can kind of unlock the deductions. Um, I would say out of the people that I work with, I mean, most people don't qualify for the real estate professional status because they have day jobs and they work 2,000 hours in their day job. So they have a hard time meeting the 50% rule. Because sometimes people will say, well, hey, I still spend 15 hours a week working on my real estate. But if you don't, it has to also be more than 50% of all of your time. So if you have a 40-hour a week day job and you make, or you're, 2,000 hours a year on that, you would have to have 2,001 hours in real estate. All right. So some of that kind of stuff makes it a little bit tough to qualify. But only one of the spouses needs to qualify. So sometimes if a husband works and a wife does all the real estate, that could actually get you to qualify. Um, there is like you do have to check a box on real estate if you're gonna group your properties. There's an election. All of this stuff is just checking boxes in returns. But every year, though, you have to kind of check the hours and qualify. So, if in year one you were a real estate professional, that doesn't mean you'll always be one. Every year you have to meet the two tests. Okay? So we'd want to pay attention to that kind of stuff. Let's see. What happens if last year you were not a real estate pro and ended up owing taxes? Can we register as a real estate professional this year, carry over the expenses that are disallowed from 22 and 23? Okay, that's a good question. If you have passive activity losses from a previous year, they're not going to be released with a real estate professional election. Okay? Those buckets still remain. And usually, like if a spot comes down to that, you actually want to do quite a bit of consulting to make sure that you don't really screw anything up with that. You don't want your passive losses to kind of get tied up in a case like this. We've had situations where somebody, wanted to group their rentals all together so that they would qualify to be a real estate professional, but then what ends up happening is if you have passive activities, like now all the rentals are grouped together and they have to be kind of like sold together in theory. So if you sell like one of the properties that you had grouped and they had prior year passive losses, you can't release those prior year passive losses because the other properties that they're grouped with are not sold yet. It's really kind of a silly. I hate that rule, but making an election to be taxed as a real estate professional in a grouping election is something that I want to really stress needs a decent amount of consulting. All right, what do I need to take credit for an energy efficient hot water heater? So there's really like a bunch of different ones that qualify. Usually when somebody gets one, I always just tell them to send me like the invoice so that I could figure out which one it was, and then I kind of just look up if it qualifies or not. But I'd be talking to whoever your installer is on that type of thing and seeing if they have something. Usually all those places have something that says this qualifies for the tax credit. All right, let's see. A few more minutes. All right. Should income from a short-term property, Airbnb, be reported on Schedule C or Schedule E? That depends. That depends how active you are in it. Um, in general, Airbnbs can be considered active and reported on Schedule C, but you have to provide significant services for that and you have to participate. If you have let's say you have a management company and they do all the work, you're not going to qualify for it to be filed on Schedule C because they're doing all the work. Now, if you're self-managing, and you go over there and you change out the towels, and I mean, you can still hire a cleaner, but maybe sometimes you clean, sometimes they clean. If you're materially participating in that and you're providing services for that group, then you can justify it being on Schedule C. And that's where people have used what's called the Airbnb loophole. Because it's active, it doesn't fall into that passive bucket of income that I've talked about before. And what people will do with their Airbnb is do a cost segregation and accelerate their depreciation. They'll self manage it and then get a nice tax deduction on the personal side. So that's just something to think about, but a good question. All right. I think I'm kind of done. I There is a couple questions that I didn't get to in Ray's thing, but I'm going to save a couple of those for next time. I appreciate you guys being here, and hopefully you found this to be educational and helpful. I do these every month. Feel free to share this type of stuff with people that you know who maybe have accountants that are busy, have accountants that aren't answering their questions. Um, the Prosperity Society platform itself is something that we're really committed to and are working hard on. Maybe some of you guys will see ads that we're starting to run. Maybe some of you have noticed on the home page in the bottom right corner, we have a place where you can text questions to now as well. But this is something that we're ongoingly going to continue to develop and continue to build a great knowledge base on. And so if you want to share that with people, we really appreciate that and want to continue to build this to where it's a great value add for people. Anyhow, I appreciate everybody being on here. Feel free to go look at other videos that I've been doing on the Prosperity Society platform. And as always, thanks for a productive call, and I will talk to you all soon. Thanks so much.